some employment numbers to look at today. Payrolls increased in 41 U.S. states in May. Yep, I said increased. Most of that, though, was government hiring. For some reaction, let's head to a Bloomberg Best. Guy Lebas, chief fixed income strategist and economist at Janney Montgomery Scott. Bloomberg Best means we bring you only the best people on the economy. Economists who are the most accurate forecasters in the world. Guy, great to have you back with Matt and myself. So payrolls up in 41 states, but a lot of it is government hiring. So what then should we read into these numbers, if anything?
Well, there are a couple of things here. First of all, the fact that payrolls are up in such a broad-based portion of the U.S. is certainly an undeniable positive. At the same time, the fact that the government is effectively now subsidizing the labor markets in many respects kind of brings to question how much of the economic recovery we've had so far and how much going forward will be really government-driven rather than kind of organic and underlying.
Well, what's the answer to that question? I mean, what are you seeing as far as passing the baton kind of from public spending to private demand?
Well, that pass of the baton has happened relatively well in terms of corporate spending, also in terms of the early stages of consumer spending, but it has yet to really take effect within the jobs market. And frankly, the census, the timing of the census is a little bit awkward this year because it's clouding our ability to see what's really happening in the underlying aspects of the jobs market. There's one camp, and we believe in this sort of theory, that says that Census Bureau hiring is actually taking away from other seasonal jobs and artificially lowering some of the payroll increases in, say, construction and other industries.
When you look around the globe at this, not the globe at this point, around the country at this point, do you think things, Guy, are getting easier for our nation's municipalities, for our cities, for our states?
Sure, and I think that's an excellent question, and something that we in the fixed income strategy side have been very focused on. There are a lot of headline fears out there these days about a municipal meltdown, I think is a phrase that many people use. But in the reality of it is that tax receipts are slowly beginning to recover for many municipalities, and the majority of these municipalities have the ability to issue debt through this downturn. So I think their ability to pay has proven quite strong. One thing we're focused on now actually is more willingness to pay. And we've seen a couple examples, for example, Harrisburg, Pennsylvania, in which politicians have said, well, let's maybe not pay off our bonds so we can avoid raising taxes on our residents. And that's kind of what concerns us for the next part of the cycle.
You know, Alan Greenspan was out today warning about, the false comfort that we can still lend as much as we still borrow, I should say, as much as we want. Is that a concern on the state and municipal level as much as it is, or as much as Alan Greenspan thinks it is on the federal level?
Well, the amount of state and local municipal debt that's outstanding is relatively small in proportion to the total U.S. government debt. If memory serves, the amount of treasuries outstanding are in the neighborhood of $6 trillion, as compared to state and local municipalities a little bit closer to $3 trillion of obligations. And when you consider that total spending is actually about 60% at the state and local level in terms of government spending, that actually indicates a lower level of indebtedness at the local and state level and at the federal level. And I think that says, well, state and local governments aren't quite as stressed in some ways as the federal government, so many will be able to continue borrowing so long as we as investors maintain confidence in that ability.
Yeah, that's certainly key. You know, the other thing that was kind of floated for a little bit, Guy, was whether or not we could see maybe a second stimulus. Do we need a second stimulus program in your view?
Well, I think right now we really need the private sector to sort of latch their gears in and continue the rotation that's already been started by the first round of economic stimulus. At this point, we're not expecting a double-dip recession in the U.S., certainly not if things progress as they have been over the course of the last couple months. What we really need is the federal government to kind of step back a little bit and allow the private sector to take on that underlying, that organic strength, and I think that's going to take probably at least the rest of 2010 to really emerge.
You talk about the need for private sector. Matt and I have spent a lot of time talking with guests about the prospect of higher corporate taxation, higher interest, higher taxation, if you will, kind of across the board. Might that, though, prevent the private sector from kind of gearing up when it comes to hiring?
Certainly, and a higher taxation is not going to create the sort of incentives that the private sector uses to be able to engage with more jobs and greater spending and sort of greater investment in their long-term future. And I think that's where the greatest problem is. However, at the same time, that greater taxation or the possibility of greater taxes will also go to supporting the long-term health of the U.S. fiscal situation, which is also something that's been attacked a lot recently and thought of as a potential long-term risk to economic growth. So I think really what higher taxation will do is support the U.S.'s fiscal health in the long run at the expense of maybe a little bit of short-term pain for corporations in particular.
Hey, Guy, thanks so much for joining us. Bloomberg Best, Guy Lebas at Janney Montgomery Scott there.